Hi, good morning. This is Hyperwave. We missed you guys yesterday. We have Tyler here, of course. Apologize for the 7-minute delay. Life is just a little slow right now, but really fun. We're going to be doing a lot, if you guys saw the title. So gold, oil, S&P, Bitcoin, because there's actually a lot going on in all of them. So I will turn this right over to Ty, so you guys don't need to stare at crutches anymore. Okay, Ty.
Great. Thank you very much. Thank you, Leah. And we really appreciate all the work that she's doing for not only Hyperwave, but for the morning brief. And she hasn't missed a beat. And that's really terrific because I know she's been in a lot of pain and the recovery is very difficult. So everybody really appreciates the work, but no more than I do. Today, we thought we've been getting a lot of questions from a lot of people about the traditional markets. So we're going to take a close look at those along with Bitcoin. We've got a lot of wild things going on. Wild means to me unpredictable in terms of volatility, with very big implications, not just volatility. I don't really care if things go up and down quickly. What I care about is the bigger picture, which is the macro picture of what does it all mean when a number of different markets begin acting in a trending way. I'd like to try to understand, why does one trend in a particular direction while others are doing other things? Someone pointed out to me in a group that we've got on Hyperwave research that the hash rate is in a hyperwave in a phase 3. And I'm still thinking about that. That's been 3 or 4 days ago, and I've talked to Giacomo about it, and I want to talk to Jimmy about it. It's a very tricky question from one particular point of view, and that point of view is you would think there is a close correlation between Bitcoin prices and the hash rate in terms of long-term trends, not short-term volatility, but major trends. And we already know that Bitcoin is in the downslope of a hyperwave. What I found fascinating is that the hash rate just moved into the third phase of a hyperwave precisely at the point that Bitcoin prices in December of 2017 began their downswing, which has now lasted for 6 months, and I believe it's going to last longer. So that's it's that kind of correlation that I like to spend a lot of time thinking about, how a part of a particular asset class, in this case the hash rate, is acting very differently than I would have expected, and I think most people would have expected, if you're moving from a bull market into a bear market. And we've got all kinds of people that are weighing in on that question, but I'm still not satisfied I have the slightest understanding of how that could be. So anybody that wants to weigh in on that topic, I'd love to hear about it. But the reason I use that particular example is we've got a lot of other things going on in the world. China is now officially in a bear market. Their stock market down 20% from top to bottom, and it looks like it's still falling. Now, a lot of people will say, well, yeah, that's because of the trade war, and there's no way they can win a trade war with the United States. And the United States market has not fallen very far. It's been kind of rumbling around. We're going to take a look at it in just a second. But there's an interesting correlation going on there. Between the Chinese market and the US and the other world markets. So that needs to be understood on a fundamental basis. And again, that's not something anybody can just throw out, oh, it's because of this or because of that. It needs a lot of thought, a lot of work, but it's interesting and important. What we're going to look at today basically are three main asset classes: stocks, gold, and oil. Gold and oil are, of course, commodities. They are correlated sometimes with the US stock market, sometimes they are not. The price of gold is sometimes correlated with the price of Bitcoin, sometimes it is not. So there are fairly big things happening in all of those markets. So we're going to take a quick look at them. And then I have not looked at the charts recently. Leah has built some this morning, and I'm going to ask her to bring them up in a screen share. We'll start with the S&P 500, and I'll just make some comments about it. So Leah, if you want to screen share. Great. Okay, I'm going to make this big for myself. We are looking at the S&P 500 going about 2 years back, the summer of 2016, summer of 2016. So it's about a 2-year chart. And the only thing I've got on this chart other than price are the 3 moving averages that I've been talking about in terms of consensio. And those moving averages are a very short 2-week moving average, a little bit longer 7-week moving average, and then a 30-week moving average, which are approximately a 14-day, approximately a 50-day, and approximately a 200-day, approximately within about 10%. I just happen to like these particular moving averages. So we've got the price and 3 moving averages. What are you looking at? What we're looking at for a period of time starting back in May of 2016 is a bull market with a little punctuation in terms of a correction as we go into 2017. Things flatten out a bit, but definitely through all of 2017 right up through the beginning of this year, in a bull market with price above all moving averages and all moving averages.
Ty,
yes,
totally my fault, but I had you on the screen, so sorry guys. Now the trading view is the full screen. Sorry about that, but
okay, great.
But I think that's okay. Yep.
Okay, very good. Thanks. So once you can see that basic pattern, and then you can see on the far right hand of the chart, what we're looking at is indecision. Indecision meaning we're going from a very clear bull market into something else. And that something else can be a lot of different things. It can be simply a correction in a bull market. It can be the beginning of a bear market, and all the variations in between those. And as you know, there are hundreds and hundreds and hundreds of variations between a bull and a bear market when you're talking about these 3 moving averages. So at various times over the last 5 months, I have gone from fully bullish to kind of fully bullish, where I raised 15% cash for clients and threatened to raise more. I threatened to raise more when the price dropped down through the long-term moving average, which is the gold line you're looking at. And it did it on a couple of occasions, but never held below it and quickly regained its footing. And then we went back into a full bull market 3 weeks ago, where price was above the short, price was above the intermediate, price was above the long, and they were all moving up. But that has now once again come to an end over the last 2.5 weeks, and was very accurately predicted by the sequential system as interpreted by Tone Vays. Anybody that wasn't watching that should have been, because it once again proved to be very accurate. The numbers on it, for those that don't believe in TA, or those that don't really understand the sequential system, the numbers range between 65% accuracy and 80% accuracy, which is the highest of any technical system I've ever seen, looking at literally hundreds of different technical trading systems. But that's really only in the hands of a real expert, not a bot, not someone using the old sequential system, but the variations that Tone Vays has put on it. You can question that if you like. I do not question those numbers that I've just used. In any case, on the S&P 500, notice that we have had lower highs and lower lows until recently. We have challenged the secondary high 2.5 weeks ago, but really didn't get much above it, and now we're heading down again. The moving averages are all coming together, which is always difficult with Consensio because it shows a sideways market. And you are going to begin seeing many, many crosses of all the moving averages in price if we keep going sideways here. The good news is that the long-term moving average continues to move up and will continue to move up for a long time. But other than that, I do not like the fact that some other indexes we're going to look at shortly have gone to new highs and the S&P 500 has not. There are fundamental reasons why that is the case, having to do not with the corporations in them and their earnings, but the way the various indexes are calculated, with the Dow being calculated on a price basis and the Nasdaq and the S&P being calculated on what is called a cap weighted basis, which means the biggest stocks have the biggest influence over the direction of the markets. And there are a lot of shared stocks across all the indexes, the Dow, the S&P, and the Nasdaq. They are not exclusive. Therefore, if you get big stocks in one index, it's going to also influence other indexes. Okay, so just looking at the S&P today, the good news is price is still above the long-term moving average, which is rising, period. The bad news is we are taking an awfully long time, now going on 6 months of this sideways action, and we're still showing lower lows and lower highs. We need to get this movement going. Tone Vays believes, and it's not a part of the sequential system, it's other things that he uses, that the stock markets are okay and will soon begin hitting new highs across all levels. I also believe that, but I believe it a little bit less today than I did 2 weeks ago and 4 weeks ago when I put that 15% cash back to work in the markets, and I called an all clear on the markets because the Nasdaq began breaking to new highs. So that's the way I'm looking at the S&P right now. Let's take a look, Leah, at the Nasdaq, and then we'll look at the Dow. This is the Nasdaq 100, which are the 100 largest companies in the Nasdaq. The Nasdaq's got a couple of thousand stocks in it. Do you want to go back to the Nasdaq? Okay, great. Thanks. Okay, here we're looking at the Nasdaq, and you can see at the same point, we're not going to reiterate what I just said because all the indexes look the same over the last 2 years, basically. We were in a bull market until earlier this year, and then we began to go into this indecision pattern. And in this particular case, we do have higher highs, and we do not have lower lows. So the Nasdaq is clearly stronger than the chart we just looked at was the S&P. And it was on that basis that I made my call that the all clear had been given, and those that want to be in the equity markets can be fully invested according to the way I look at markets. Now some funny things are beginning to happen again. And I talked about a thing I call a broadening top, which is part of a system called the Selgin system that I created back in the 1970s off of a Wells Wilder system that had been created off of an Edwards and McGee system. And in this case, I became excited that we had negated the broadening top. Unfortunately, that is not quite accurate. I had anticipated that the green candle 2 candles ago had gotten high enough to negate the broadening top. It did not do that. And now we're back below that again. And because I was basing the fact that the largest companies in the Nasdaq 100 are also the largest companies in the S&P 500, and some of those are also involved in the Dow, that the Nasdaq 100 would be able to pull all the other indexes up. As we sit here today, that is not the case. I do believe it will be the case. Here you've got the long-term moving average moving up very steeply. The intermediate term moving average is moving up very steeply. And even the short-term moving average, with all this noise that we've had for the last 2 weeks in the equity markets in the United States and around the world, is still, even though it's moving down, it still hasn't cut through below the intermediate term moving average. So I'm looking at a very strong chart right here. And my assumption is it will stay strong. I always go by the longest indicators first. They are the most powerful. The intermediate indicators are secondary, and the short term, particularly something this short, is almost a throwaway. All I use it for is as a canary in the coal mine to give me a slap across the face when I'm making assumptions about the way the market is moving. If all of a sudden that short-term moving average begins to go down, it can't do it unless price is going down, and therefore I should sit up and take a look at it. As I look at this chart, it looks perfectly fine for me that we're going to get a big breakout to the upside, and it will pull the other indexes up. Having said that, let's take a look at one more index, the Dow Jones Industrials. The Dow Jones Industrials do not look good. Why? Look at the price. It's below everything. It's below the long term, the intermediate term, the short term. The long term has not really turned down, but it sure looks like it's about to. But that might just be an optical illusion. What is clear is the short term is cut through both the intermediate term and the long term, and the price is below all of that. So if I only had money in the Dow 30, not individual stocks, but the whole Dow 30, which you can buy by buying the diamonds, the DIAs. You can buy double diamonds or triple diamonds, depending on if you're trading ETFs or mutual funds that have double and triple long and double and triple short, and on and on and on. I'm talking about if the only thing I own today was the Dow Jones Industrials, all 30 stocks in approximately the same weighting that they are in the Dow on a price-weighted basis, I would be very nervous. I would not have 100% in the market any longer. I would not have 85% in this market any longer. I would barely have 50%, and I would be very nervous that I would be getting even more negative. Now, that's very different than what I said about the Nasdaq, and it's also different than what I said about the S&P 500. So there's something going on here with these 30 stocks that are not going on with the 500 stocks in the S&P or the 2,000 stocks in the Nasdaq. So that's simply the facts. But you have to step back now and start asking questions. Why would that be? What are the fundamentals that are different in this index compared to the others? And the obvious thing to me is this trade war or potential trade war or trade war as a bargaining chip or trade war is the first round of getting our trading partners and our close friends in Canada and Mexico and our not so close friends in China and some of the other countries around the world as an opening salvo to say, look, we're really serious about this stuff. Let's try to bring trade back into line with something a little more reasonable from the US's point of view. And one of the ways, remember, the Dow is made up of major corporations that are across all industry groups and not heavily weighted in technology compared to the Nasdaq and the S&P because they're cap-weighted index. This is just on the basis of price. And there's only 30 of them. And many of them are being bandied about in this trade war talk in terms of reciprocal actions by other countries. So it could be that's what's going on with the Dow. It could be that the Dow stock earnings are not keeping up with the earnings of some of the other indexes, which happens to be true. And that's because there are some big, old, ugly companies that in general don't tend to be growth stocks. And so their earnings have not been doing as well as other stocks. So all I'm saying today is be on your toes right now in terms of your decisions about the equity markets. The fact that I believe or I think or my opinion is that the US markets are fine should be irrelevant to everyone. My reading of these charts is saying that something is going on that is beginning to look more ominous than it did a month ago or 2 months ago or 3 months ago, or certainly any time over the last 2 or 3 years. And we can get into all kinds of things about yield curve inversions and Fed policy and the fundamentals that are going behind the economic growth. But let me just say this. We are still in one of the strongest expansions we have had in terms of its length, not in terms of its overall GDP growth. In fact, it's one of the weakest expansions under the 8 years of Obama that we've had since World War II, even though we were expanding at a snail pace. That has changed under the Trump administration to a booming economy, a booming stock market, lowest unemployment, basically historically. That's a hyperbole, but it's pretty close. Earnings are growing at a rapid rate, much more rapid than almost anyone, including the administration, thought possible in such a short period of time, meaning in a year and a half since Trump took office. And we have got GDP that's probably going to print a 4% number, not a 3, not a 3.5, not a 2.5, like everybody believed was the max, not a 2, not a 1.5, like everybody thought we were going to be stuck in for the rest of our lives. We have had a fundamental shift in the economic stature of the United States, not in terms of opinion, but in terms of the numbers. And that is showing up in these charts. With all of that said, this Dow chart is looking problematic. And when one portion of an asset class, stocks, begins to have problems, that doesn't mean you have to ignore what you're seeing in other indexes, other US indexes, but it means you need to sit up and take note. This is the kind of thing that every day and every week over the next month or two, anyone that is in retirement accounts heavily weighted in stocks, trading accounts that are heavily weighted in stocks, doesn't mean you need to take action. It means that you need to be alert. I will try to help keep you alert because we will do this kind of analysis more frequently. Okay, let's take a look at the, yes, please.
Someone, I don't know why I was going to echo, said to check out the S&P monthly. Can we do that?
Sure.
Great.
And why don't we take it back, you know, like 10 years?
Let's do it. Sorry, guys, I'm still slow on this, but here we go.
No hurry. Great.
All right.
Okay. The S&P monthly on a 10-year time frame. Now, remember that the moving averages we're now looking at are monthly. So when we have when I say the short term, that's a 2-month. And when the intermediate term is a 7-month, and the long term there is a 30-month.
And that he's mentioning a shooting start on the monthly.
Yeah. Which is a description, of course, of a candle. And let's just sit back and take a couple of looks. What we're seeing is the short-term moving average has broken down below the intermediate term moving average, as has price. But just briefly, price has now gone back up above both of those moving averages, and of course have not come anywhere close to the long-term moving average. So on the S&P, I would say that even though, remember that shooting star is a candle for June, and we've still got a week to go or so on that. Anything can happen here, up or down. We could turn that negative, even though it's a monthly, just with a little bit of downside from here. So too early to make the call. On the 1st of July, we'll take a closer look at that particular candle. But my reading of this chart is we see the end of the bear market on the far left of the screen. We see the beginning of the bull market, and it went very slowly, but surely with only 3 real corrections up until the one we are in now. The one we are in now is bigger even than the third correction, not as big as the second correction on a percentage basis, about the same, probably a little bit bigger than the first correction. So over a 10-year period, to only have 3 corrections up to the current time is clearly a very, very strong bull market, and one that you can question, but I wouldn't question it too strongly off of this chart, because we've had such a great bounce back in the last 2.5 months from the penetration of the intermediate term low. So I'm not going to make any calls off of this, other than to say it is the 4th correction in 10 years. We know how the other 3 ended up. The probability is that this one will end the same way, by going to new highs. The Nasdaq is already telling us that is a probability, because the strongest and biggest companies in the US with the best growth are already moving to new high ground. So that's the way I would read this chart. Let's take a look at gold.
You got it.
Now, as we're looking at this gold chart, let's keep in mind my concept that there is an overriding significant macro problem in the world that has to do with debt. And that spawned the whole Bitcoin crypto craze, in my opinion. It also spawned the movement of gold prices from the sub $1,000 level to $1,900, a 90% increase during the 2000 to 2010 period, 2008-9 period. And then a big correction in 07, 08, 09 that took us down all the way back to 1100 from 1900, and then a new bull market in gold that has taken us from 1100 to 1375. Okay, on the left of your chart, you see that 1375.80 top. You see it again in September, October of last year, and you see it again earlier this year, 1380, 1375. I've been saying that using Consensio, you can be in and out of this market, but most of the time from the bottom at 1120 at the end of 2016, we've been in a bull market or something resembling a bull market. I wasn't ready to say we are back in a bull market fully until we get over 1400. I think over 1400, we're going to move quickly to 15 and 1600, and then have the ability to challenge the all-time highs. That plan is rapidly falling apart. If you take a look at the far right of the chart, this is a weekly chart, so you can count back 1, 2, 3, 4, 5, 6, 7, 8 weeks or 2 months. And you see that once we broke that longer term moving average, the gold line, there was no more oomph left in the buyers. We had the short term turn down, we had the intermediate term down. They both cut down through the long term. Price then cut down through the long term. Price retested the long term moving average 2.5 weeks ago, was rejected, and now we're going to lower lows. Notice that the long-term moving average looks like it's rolling over also. This is not good, folks. I would say that you do not want to, you want to be lightening up on your gold positions just based off of Consensio. and we have the possibility of going to lower lows. We've had higher lows along this movement. We've had higher highs, very grudgingly, but we've had them. But now we're in a position to actually take out that previous low at the beginning of 2018. It's only slightly lower than where we are right now, but the rapidity with which this price is coming apart, it is not, you are not going against the odds, the probabilities, when you assume that we could take out that low, and then we've got a whole new ball game going on. So I have been warning that 1350, excuse me, 1550 on silver, $15.50 on silver, makes me nervous, and below 1450, I think we could be entering another down wave on the silver market. On this gold market, we are already in a down wave, as I just described. We have not put the icing on the cake or the sprinkles on the icing by going lower than that previous low at the beginning of 2018. But this is not a good looking chart. It can turn around fairly quickly, and it might very well do that. So the possibilities are still there. We're not far away from the overhead resistance at 1380, but I don't like the way it's acting right now. I've told my clients who are involved in our consulting program that they should be and have been lightening up ever since these consensual lines have turned to the downside. And by lightening up, I have given the instruction of 50% reduction in the holdings, their target holdings, whatever those might be. Okay, so that's, yes, please.
On this one, ooh, whoever recommended turning the volume down, I think that worked. The question, what do you expect the lowest gold can get? Or because the way I understand it, $1,200 mining facilities will start losing money.
Okay, a fundamental question and a technical question. You can never project prices based on fundamentals. You can make price projections based on technicals, but I try to avoid doing that unless I've got a surefire technical system. And the only one that I know of that is very, very accurate is the Hyperwave system. And that's only accurate for projecting prices when they are returning back to their phase one line. At all other times, trying to project or predict prices as opposed to predicting direction, which is what all the systems that I have developed and tend to use in technical analysis, are not attempting to predict either price or time, but simply direction and momentum. And that's what Consensio is completely based on. But having said that, the fundamental caveat that was put into that question had to do with mining prices. Folks, it is not wise to try to use what is the stated cost of mining, either Bitcoins or gold or silver or pumping oil, to make decisions. You can take an average of what all the corporations say their costs are. You can have outside analysts have different opinions, and you can take the average of all of those. And if those two averages are fairly close between what the mines or the corporations themselves say, what outside analysts are saying, then you can assume they're probably ballpark. And if they're probably ballpark, what does that mean? Well, it means that it's going to hurt when prices spend too much time lower than that value. What does that mean? Not very much. What does too much time mean? It does not mean weeks or months. It means years, but the question is how many years? Well, that depends. What does it depend on? The corporation. How liquid are they? How much pain can they take? What are their lines of credit? What are their finances looking like? What does their balance sheet look like? And then you get a huge spectrum between very small companies that are really highly speculative, that if the lights go out for a night or two, they're out of business, and very, very well capitalized companies that hope that that sort of thing happens so they can put a lot of their competitors out of business. In terms of you as an investor, trying to make decisions on things like what the cost is in general or specifically for somebody, good luck. I don't think you can do that very well. Okay, that's not answering the question. Do I have an opinion on where gold could go? I think my immediate thinking is that gold could retest the old lows down between 1,000 and 1,100 or 1,150 easily. Do I think gold can break 1,000? Absolutely. Do I think gold can enter a major bear market? Absolutely. What would the fundamentals be to do that? Well, one would be massive adoption, in my opinion, of Bitcoin, not of the cryptos, but of Bitcoin. Are we anywhere near that? No, not even close. What else could it be? Well, it could be a declaration by the G7, the G30, the G50, all the major nations of the world, that they will never, under any circumstances, return to a gold standard. And statements by all the central banks, starting with the US and with the IMF and with the World Bank, that under no provision will we ever return to a gold standard. I believe that declaration will never come, but if it were to occur, I believe you would be in a major bear market that could take gold much, much, much lower. Are there any other macro things that could happen that would either be very bullish or bearish for gold? Absolutely. One that I am counting on, which is the realization by nations of the world and central banks advising those nations that we must return to a gold standard. We must peg the price of gold at triple or quadruple or 5 times where it is right now. And we must do it quickly, and we must all agree on it. Otherwise, we will not ever be able to control this debt situation, and we're going to start getting Italy's spreading to Portugal and Spain and throughout the Eurozone and throughout Asia because of all the negative interest rates, and finally in the strongest economy in the world, the US. All of that is theoretical, but somebody else give me a solution to the debt problem other than saying that there is no debt problem, it will simply go away, which is what 95% of politicians say and believe and understand. And most people that are trying to minimize what a monumental corner we have painted ourselves into, and there are no doors in this corner whatsoever, other than a total revamp of the world financial situation. And as that is being debated, we're going to see Bitcoin do what it is doing, which is going into a hyperwave on the upside and then the downside of a hyperwave. Because the Bitcoin community was not ready to take on the challenge of world finance. We're going to see gold go up very, very sharply into bull markets as rumors begin to spread and inflation begins to come back and the dollar begins to weaken. And we are going to see markets like the US stock market, because it is such a leading factor in the world economy, put in its 2 cents every once in a while, like it is doing right now in terms of hesitation, even though the underlying economics are so strong. So that's why we wanted to talk about all these disparate wild markets right now, because they've got much larger implications than just should you buy it or should you sell it. And we're trying to give you some perspective on that. Why don't we take a look at the last chart before we get to Bitcoin, which is the oil chart. Now, this is very important because oil had been struggling. Out of the 10 sectors of the S&P 500, including technology and finance and consumer durables and utilities and all of the various sectors, the weakest in this bull market that started 10 years ago has been energy. Until you see this May, June, July 2017 period, where we tested lows from 6 months earlier and then broke out to the upside. So we had been playing around in the 40, 45, 50 area. A lot of people saying we could go back down to 30, to 25, maybe to 20. A lot of people said that's insane. We could never get that low. Nobody was really sure. There was a lot of questions about OPEC, a lot of questions about the U.S. and our ability to become actual net exporters of fossil fuels, all of that stuff. That was resolved a year ago in the summer of 2017, in my opinion, and we entered a bull market. And that bull market took prices from 40 all the way up to 72, 73 in a fairly short period of time for oil, well above what most analysts were expecting, as is usually the case when you get a break in trend from one direction to another direction. It's very difficult to tell unless you use technicals like Consensio, and then it becomes obvious as the moving averages begin to spread out, and corrections like what we saw in early 2018, where the price began to go sideways for 5 weeks. The short term dropped down and touched the intermediate term, and then that pulse was over and we got the next pulse up that took us all the way from the 55 area to 70, almost nonstop. 68, then another correction down to 58, then this big move up that we've just had. So out of all the markets, the one that is acting the strongest is the one that had been acting the weakest for years and years and years. I have shown you that sector rotation is one of the most important tools you have in your toolbox, but you need to follow it. And I posted a 20-year chart of the 10 sectors of the S&P to illustrate from that 20-year period through, and I made the comment that you can look at any 20-year period going back 100 years and you will see the same thing, which is when a sector is on the top of the 10 sector list in terms of total performance for a year or 2 years or 3 years, it's getting ready to go all the way back to the bottom of the list. And when a sector is at the bottom of the list for 1, 2, 3, 4 years, it is preparing to go all the way to the top of the list. And that happens over and over again throughout history. We don't need to go into the reasons and the causes, but that is what capitalism and the markets are all about, is sorting out overbought and oversold situations. And it occurs gradually, but slowly, steadily, and you can bet on it with a high degree of confidence. Where you don't get that kind of activity is in the middle of the range. If you look at number 3, 4, 5, 6, in terms of how often those sectors stay at 3, 4, 5, 6, and 7, and all they do is they go from 6 down to 3 and then back up to 6, or 6 down, or 3 up to 6 or 7 and then back down to 4 or 5. They stay in the middle, but not the ones at the top and the bottom. Oil was at the bottom. It's now at the top. It's the best performing in 2018, along with technology. Technology got hit the hardest since January 1st, had the biggest percentage drops of all the sectors. But because the long term is still positive, the Nasdaq is still positive. So that's just an overall way of looking at this stuff. Oil tends also to be a very good indicator of commodity prices in general, and therefore inflationary prices in general, because it's used in so many things other than just transportation as a fuel. It's used in the making of plastics, and on and on and on and on throughout the entire system. And because of that, it tends to be a pretty good leading indicator for what's called the PPI, which is the producer price index, which is closely related to commodity prices compared to the consumer price index, which is mainly just an inflationary consumer, what's the consumer spending, and on what items, and are they willing to pay up or pay down for it. Okay, so that's a fairly quick, a lot longer than I wanted, but a fairly quick look at some fairly wild markets and my takes on them at this point. And now I'd like to move to Bitcoin, which is central to all of these discussions, in my opinion, on a fundamental basis, and certainly on a technical basis. It's why I got involved in these vlogs with Leah, because it was so obvious to us that Bitcoin was in the upswing of a hyperwave, which has all kinds of implications. And unfortunately, in December, it decided to run out of gas and has been in the last 4 phases, 5, 6, and 7, last 3 phases of the hyperwave, and still is in that. So if we could take a look at Bitcoin, Leah.
Oh, you want to do it on mine?
Well, okay. let me see. Let me pull it up on mine. If
I had you on screen share, but yeah, because also someone asked, which I think is great, if you could draw the phase 2 line again so we can get a visual like we had when the phase 3 was drawn.
Okay, sure.
All right, you're back on screen share, by the way, or you're on the screen.
Okay, very good. I will show you where I have my phase 2 line drawn in by looking at the full movement over the last 3 years, basically. And this little line is my phase 2 line. It's crossing right below the 5,000 level. It's moving up at about $82 per week. And we are still above it, but we are about to test it, in my opinion. And we will see what happens when we do test it. I believe we will bounce strongly off of it the first couple of times. and hopefully we will bounce off of it and keep going to the upside. And that will be the beginning of a funky hyperwave and the end of the hyperwave you're now looking at. But I don't believe the probabilities are not on the side of that happening. I'm giving a 1 in 4 probability that it will hold and we will go higher and start a new hyperwave that will take us to new highs off of that line. And no reason to guess. There's no reason to speculate. There's no reason for opinions. My guess of 1 in 4, I pulled out of a hat. True, I've looked at hundreds and hundreds of hyperwaves. I've looked at dozens and dozens of funky hyperwaves. I think that 1 in 4 number is not far off. It's not far off, but I'm certainly not, don't want anybody to hold me to that. That is simply from a lot of experience of looking at a lot of these waves. If it holds, the actual number was 100%. It was a certainty it was going to hold. If it doesn't hold, there was zero probability that it was going to hold because it broke. So let's just let's look at it in that light, because there's a possibility and a high probability we will at least bounce off of it. Some of you might want to use that as fuel for a strategy, which is fine. I will tell you that I am telling our consulting clients that I would not, I would expect that even if it holds, meaning the phase 2 line holds on the first penetration of it, remember that we are only concerned about weekly closes. We're not concerned about penetrations. And what that means is that if it drops down below that line, it could easily drop 4,900, 4,800, 4,700, 4,600, 4,500 before turning around on Wednesday, Thursday, Friday, Saturday, and closing above it on Sunday. That's precisely what the phase 3 line did, and it did it 11 times before it finally broke down. So knowing that this will tend to be a very strong support, you have to come to your own conclusions about how you are going to approach it, and what you want to do above it as you get closer to it, at it, and below it, in making your decisions. Those are just clues. Those are just hints, but that's from somebody that has got a lot of experience with this thing called a hyperwave. Okay, so that's the phase 2 line. Let's go back to the recent chart. We hit a low 2.5 days ago of 58.32. We bounced strongly off of it, and we had a very nice looking reversal candle, which Tone says he is not impressed with. We then followed that with a negative candle, and now we're again messing around the 6,200 level with a high this week, which only began last Sunday. I'm sorry, that's a daily. Let's go to the weekly. 1 week ago, 58.32. Let's go to the daily. Okay, on that daily, we're messing around since last night with a range of 62.45 at the top and 61.20 at the bottom, and really just going sideways. This is a pulse down. This is the sideways activity. Unless we can do something pretty powerful to the upside, the next move, probability-wise, is another pulse down, just as we saw here, a pulse, sideways action, inability to get high enough into the pulsed daily candle that the next pulse was to the downside once again. That is what I am expecting. I have got a target of 6,300 on this pulse down, and the next, 5,300 on the next pulse down from this level. And that is simply based on my observation of 5% plus pulses for this asset class, Bitcoin, from the resistance high between 10,000 and 11,750. That is not a precise number. Most of these pulses are closer to 7.5%. I'm trying to be conservative when I'm picking my targets. Even though my intermediate term target on the downside is 5,000 or below as it approaches the phase 2 line, I think a pulse down from current levels to the 6,300 level will find some support around that level. And then we go sideways, getting ready for one more attack on the phase 2 and Tone's 49.75 level. So nothing has changed in terms of Bitcoin in my mind since you heard Tone and Leah and me discuss it several days ago. Even though there's been ups and downs and wiggles, that is to be expected with something this new and this volatile. You need to ignore all of this short-term movement and look at the big picture. And as I do over and over again, it is a very simple big picture. We'll take it all the way back to the top. I'll get rid of that top. We'll start here at 17,000, which is the level you should have gotten out of between 15 and 17,000, all of your Bitcoin. I don't care if you're a hodler. I don't care if you're a maximalist. I don't care if you believe this is going to someday be $1 million. None of that matters to me. The only thing that matters to me is the trend of a market. The trend of a market is knowable. All of those other things are not knowable. Guessing prices is not knowable. Guessing endpoints or how quickly a trend will get somewhere is not knowable. You can put probabilities on it, but one thing is knowable, and that is the definition of a trend. A trend is that which the price in a downtrend is below a short-term moving average. Define that yourself. Which is below a long-term moving average. Define that yourself. Which is above an intermediate term average. Define that for yourself. That is the definition, my definition of a trend. And it is knowable until a trend change takes place. A bull market, which this is on the left side of the chart, is knowable. You don't know how high it's going to go. You don't know how long it's going to take to get where it's going. But you will know when that changes from an uptrend to a downtrend by analyzing those 4 pieces of the puzzle: the price, a short-term, an intermediate term, and a long-term moving average. And that's all we have been doing in this description ever since the top. Go back and look at all of our tweets for the last 6 months, where we have been pointing out points of resistance. We always go back to the main trend and say, we are still in a downtrend, be patient. My words for everybody today is very simple. are very simple. We are still in a downtrend. Be patient. And with that, I'm going to turn it back to
Ty,
Leah. Yes.
before you turn it back to me, or as you turn it back to me for another question, I like this one. When would you be convinced that the Bitcoin may turn into a funky hyperwave?
When phase 2 holds. That's point number one. But how long must it hold is the question, and what is the signal that we are in the clear? Unfortunately, there is only one signal, and that signal is breaking to new highs. As soon as that signal is given, then what it means is phase 2 was the end of what we assume to be a normal hyperwave on the downside. And now we have started a funky hyperwave down at 5,000 approximately. And we won't know that for sure because there's nothing in between 5,000 and 19,666 that can give us a clue. My point to you is, so what? In other words, so what if we bounce off of 5,000 and we go to 7,500? What you will hear me say with that bounce is we can still go back and retest phase 2. If we go all the way up to 10,000 and we're able to make it through the valley of death between 10,100 and 11,100, I will say, but we can still go down to phase 2. But remember, phase 2 is going to be moving up at $82 per week. So draw that out as far as you want to draw it. And at some point, that is going to make it up to 6,000, 7,000, 8,000, 9,000. And if the price takes a long time to get back up to 10,000, that's fine, because your bottom is getting stronger and stronger. Now, I will make one other comment because I've made it before, which is that if we can get above 11,750 on a closing weekly basis, you will hear me begin to say, even though I am not yet convinced that this is a funky hyperwave and this is simply a bounce off the phase 2 line at this point, I will begin talking more and more about the probabilities of taking out the all-time highs. And those probabilities will start going up rapidly above 11,750. They'll go up even more rapidly above 13,000, and it will become a certainty above 16,000 and 17,000. But we will not know for sure until we close on a weekly basis above the old highs that the phase 2 is still intact and it's the beginning of a new hyperwave. We will declare that. I would probably take a trip to Paris and for a week party like there is no tomorrow, because that's what I want to happen. That's what I know is going to happen. I just don't know when or how, under what circumstances. So if it's off of this phase 2 bounce, wonderful. Then we can start looking for the phase 3, then the phase 4, and we'll go into the details of how we'll do that at that point. As we keep saying, everything is incremental, a step at a time. Don't get ahead of yourself. Don't make assumptions. Don't make projections. Know where you are. Know what all the evidence on the fundamental and technical side is. Take each day one step at a time. And that's what we're trying to do in these wild markets.
What is the, just for everybody, what's the name of an asset that has gone through a funky hyperwave?
The Dow Jones Industrial Average on a number of occasions. Some of you have been looking at an article that was written back in 1990. There were a number of them, by the way. There was a cover story on the San Francisco Chronicle on Easter with a picture of the hyperwave and what implications it had. There was a conference in 1990 with 3,000 large investors from all over the world. I was the keynote speaker about hyperwave. What I did not know at that time, and if you read the article that's circulating now carefully, you will see that I was predicting a drop in the price of the Dow back down to the 1,000 level, because that was the phase one of a hyperwave. I had not yet identified funky hyperwaves until the Dow climbed back above its old high of 2,880, at which point that negated all the downside on the hyperwave and began a funky hyperwave that took us all the way up to where we are today at over 20,000, another 10x. And that allowed me to identify that gold also could go through a funky hyperwave. But the turning point for me was almost 20 years ago, 18 years ago. That was the first one I had really identified. Back in the 1970s, I identified several in very arcane markets like sugar and cocoa and played them, not understanding that what I was really looking at was a funky hyperwave, but successfully was able to invest in them on the basis of other concepts about how hyperwaves work. So it's been a learning process for me over 40 years, particularly over a full 30 some odd years in studying hyperwave. And just as it is for me, don't expect to fully understand this thing. We have got a wonderful group of people now that have come from our listeners in a group studying hyperwaves, and we will from time to time be coming out and showing you a large number of active hyperwaves that are still in the early stages with individual securities and individual commodities and individual international positions. But this is an ongoing basis. What I'm hoping to do, and the reason Leah and I decided we would call this channel Hyperwave, is this is really the first time, other than back in the early 1990s, where I introduced it. It took me 10 years after that first introduction, where I never talked about it again. I wanted to study it, find all of its peculiarities. Luckily, it worked out exactly right in Japan. From December of 1989 all the way through 20 years later. And there was quite a bit of notoriety about that because I had predicted that top in the Japanese market. But again, we never advertised it. We never talked about it. It allowed us to predict the top of the Nasdaq and the .com almost perfectly. It is helping us greatly today with Bitcoin. So that's basically my answer on the funky hyperwave.
Yes, I was muted. With your phone call, I guess one last question, and then we shall go. Is there a specific time period that phase two must hold to confirm that it's a funky hyperwave?
Once more, please.
Is there a specific time period that phase 2 must hold to confirm that it is a funky hyperwave?
No, not at all. I've said before that all of these phase waves last into infinity. Once they've been established, they go forever. And the phase 2, if it is not broken, it could go for another month or 2 or a year or 2 or 5 or 10, as long as price does not close on a weekly basis below it. So there aren't any time periods. I'm telling you now that we want, here's the perfect scenario for the bulls. And I am a bull, long-term bull. Believe it or not, for those that have just tuned in for the last 4 or 5 months, and the only thing you've heard me say is down, 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 down. That's because we're in the down phase of a hyperwave. I can't say anything other than that. But I am a giant bull on Bitcoin, not on the other cryptos, but on Bitcoin. Here is the most bullish thing that can happen. We hold the 5,000 level. Even more bullish, we never get down to the 5,000 level. We begin going up right from here. Today, tomorrow. We're still in a phase 2. And if we get back to 20,000, phase 2 was the beginning of a funky hyperwave, even though we didn't test it or break it, because it was never broken, and that line will go out for millennium. That's the most bullish thing that can happen, and I hope that happens, but I've just made it very clear that I doubt very much on a probability basis that that's what's going to happen. Second most bullish thing that can happen, we go down and we test the hyperwave, which is not far, the phase 2 hyperwave, which is not far below where we are right now. It was much further below when we were at 10,000 coming down. But since we've just hit 5,800, we're less than 1,000 points from low to the hyperwave, phase 2. So we go down and we test it, and we bounce off of it strongly. After penetrating it, probably, we bounce off of it on a weekly basis. I'd like to see another test of that, a second test, within a month or so, for the second most bullish way of looking at hyperwave and Bitcoin. And then that holds also, and then we take off. And we get up to 7,500, we get up to 8,500. We then struggle at 10,100 to 11,100, but we cut through it, maybe like a knife through butter, because now momentum is building. Now people are saying all those bears that thought we were going way, way down were wrong. And now you begin to get a change of sentiment as well as just price action. But I need to see us above 11,100 on a closing basis, 11,175. And then these other things I've talked about, the 13,000, the 15,000, I'll be convinced, even though we don't have the evidence that we are going to take out the old highs and keep on going. Phase 2, the longer it goes sideways at this nice angle, which is less than 45 degrees, is building a very strong base, then to shift to a phase 3 acceleration. I would love if we don't accelerate into that 45-degree phase 3 all through 2018 and well into 2019, because then we can work our way up to 20,000 and still be in a phase 2, which means the fireworks haven't really even begun, even though we're hitting new highs, which means the phase 3 could take us much, much higher. And then we get to phase 4, which can take us much, much higher. That's the perfect scenario for the bulls. Technically, using hyperwave, fundamentally, that also buys the ecosystem time to get its act together. for the cryptos to begin to fade away from 2,000 to 1,500 to 1,000 to 500 to 200. Just that activity alone will clean up so much of the nonsense that we're seeing. We will have a number of major exchanges that begin to get months and quarters and even years behind them, showing that they are not going to be hacked, that people can trust them. We will have wallets that can really store your crypto and your Bitcoin. And we will have all of the various things that Jimmy and Tone and Giacomo talked about yesterday in terms of innovations coming along. I love the description yesterday by Giacomo and Jimmy and Tone, all three of them, about so many innovations are coming along that as soon as one is announced and before it's ready for prime time, something better is added to it. And then something better added to do that, which takes it longer to actually get into the system, but it's getting better and better and better under the fog of what's been going on in the ecosystem. So anyway, that's my answer in terms of the length of time a phase 2 should go. We all should hope and pray it goes on for a very long period of time before we accelerate up into a higher phase line.
All right. Well, guys, I think we're going to end it here. And thank you so much for watching. We did miss you yesterday. And till next time, thank you so much. Ty?
Thanks, everybody. Thanks, Leah.
All right, bye.